Welcome to this episode of the Simply Financial Podcast. I'm your host, Christopher Calandra. This is episode number 17. We're in season number 4. I have with me returning guest, Dean Nicholson. And you may recall, if you're a regular listener to the show, that he, as I said, has appeared numerous times on the show. He is a retired financial advisor, an economist by training with a long tenured experience in financial services. Most recently, he was actually on episode number 1 of season 4, where we did a year in review. As of this recording, we're towards the end of April, and so much has changed since last time we connected. But Dean, thanks for joining me today.
Well, it's a pleasure to be here. Challenging times.
So recently I did an investor update for clients, including lots and lots of your former clients who are now my clients since you've become retired. So in general, I recorded that webinar a couple of days ago. What were some of your major takeaways?
Well, I think that your methodology is sound. It's conservative. It could be more aggressive, but under your circumstances, I thought it was very well taken, and your thoughts regarding time frames and tax loss was very important. Also, the IRA to Roth conversions, that's an important tool to use during these difficult times.
Beautiful. Well, thank you. I appreciate that. The question I wanted to start with is, in a few days, the government is going to report the Q1 gross domestic product, or GDP numbers. So given the pandemic and the U.S. economy largely shutting down over these many weeks, there's general consensus that the U.S. is headed for a recession. The first sign of that would be what happened in the first quarter. Do you have any thoughts about the likelihood that we will end up in a recession that may have begun in Q1 of 2020?
My viewpoint is a little bit different than yours, only because I'm such a number cruncher. That's what I look at. And one of the concepts that economists use, I use the gross national product, the GNP, versus the gross domestic product for most of my analysis.
Okay.
And just so your listeners understand, the GNP consists of 3 major factors: consumer spending, business investment, and governmental spending. Now, as an economist, they're all important, and for the economy, they're all important. But for me, it's the sum of the 3 that's most important of all. So obviously, the consumer spending is going to be down because of unemployment, no doubt about that. Business investment is going to be shaky for a while, but governmental spending is going to be off the chart. So my only doubt is the time delay under which all this money inflow is going to take effect. But my frame for recovery, I believe, is shorter than yours.
Okay.
And because of that tremendous growth in governmental spending, I do not honestly think, now I may be more aggressive than a lot of other economists, but I've been around so long and I've followed the market every day for like 35 years. And I've just seen what the American economy can do. And I really have quite a bit of confidence that our market is going to avoid a major recession. But that being said, I have the hide of a rhinoceros. I've been around so long, so I'm not telling anyone to do what I do. But that's just my thought.
So you speculate, an educated speculation, that we may not even end up in a recession using the strict definition of 2 consecutive negative quarters of GDP growth. We might have had one in the first quarter. We might have avoided it because January and most of February, the economy was operating at a high level, was actually accelerating, and that came to a crashing halt. So your thought is, if we avoided a negative number in the first quarter, we're likely to get one in the second quarter, but you're thinking we might be pulling out of that by the third quarter, and then we would only perhaps have one negative quarter?
Well, I would say between the third and fourth quarter, because, I've never been on horse races, so I'm not going to bet on that. But before the end of the year, I think we're going to be pretty well on our way to a recovery, and which is an important factor to remember. As an investor, you always have to take the long-term view. In the short-term view, you shouldn't be in the market in the first place. So I really do think by the end of the year, we're going to be well on our way to a return. I don't see a long-term recession. Now, maybe I'm wrong, but the market has, on the plus side, surprised me more than on the negative side, actually.
And with unemployment off the charts, to use the term you just mentioned in terms of government spending, we in 1 month have wiped out 10 years worth of job growth, with 26 million or so Americans filing for unemployment over the last 4 weeks. Now, once the economy reopens, which I believe we're moving towards in most states and locales, there'll be some holdouts, some tougher areas like New York City perhaps. So that unemployment number will probably bounce back rather quickly. But I don't think we're going to go back to 3.5% right away either, which is where we were at the start of this. So how do you think unemployment factors into some of the optimism that you have and where you think we're going?
Well, there's two factors. One, you have to look at what's the cause of the unemployment. Is it structural or is it event-related? And it's event-related. Now, the key is going to be the controls they have on the testing for COVID to allow the maximum and quick return of normalcy. The longer that takes, the greater the probability you are going to have a continuing, quote-unquote, recession or downturn. But I'm optimistic, I've always been optimistic, that eventually the government is going to be forced to do the right thing and the people are going to be forced to do the right thing. And I do think, even though that the unemployment is there, a lot of that is going to be quickly corrected because all the restaurants here in the villages, there's no one working. Well, as soon as they open up the restaurants, they're going to be back to work immediately. So because it's event-related, I think the recovery is going to be a little bit faster. But I can certainly understand your viewpoint of a more longer-term recovery. Right? I respect that.
So let me push back on that a little bit. So you're in the villages in Florida, which is where Elliott Wealth has an office, it being in Summerfield, Florida. And there are lots and lots of restaurants in the villages, which is one of the preeminent retirement communities in the country. And so you said essentially, hey, once the coast is clear, the restaurants will reopen and the workers will come back. I want to push back, though. Will the customers come back to the restaurants and the bars to the same degree that they were doing before, or do we see a drop-off of traffic at restaurants? And we could ask the same questions about other industries, but sticking with restaurants, because I would submit to you that, restaurants will open and a lot of people will go back, but not everyone will go back, and we won't see the highs in restaurant traffic and eating out. That trend line, that long-term trend line of that increasing is likely to come down, and we won't stay as low as we are now, but we won't go back to where we were, and that's going to have an impact on many restaurants in the villages, and there might not be as much employment as there were before. That's kind of my take on things. What do you think?
Well, I agree with that. The thing about economics is you never know a leading or a trailing factor. And some people are going to be more aggressive than others and more comfortable going out, quote unquote, back to normalcy than others. Others will never come back. Just like when there's a big sell-off. Some people still are in cash from 2008 when we had that liquidity problem. So I agree with you. There's going to be a delay. That's why I'm hedging my bets. That's going to be, third to fourth quarter. It could be longer, but eventually, that's why I take the long-term effect. Eventually, it's going to get back to what it was before and continue its growth because the U.S. economy does work. But I'm not going to argue against you. It is going to be a lot of uncertainty about who's coming back, how aggressive they are, how comfortable they are, and everyone's different. So your point is well taken. I accept.
To be fair, I mean, I am long-term equally as optimistic as you are with the ability of the U.S. economy to be resilient, and the American people, the American worker, American leaders, both in public and in private, will reinvent themselves, change, adapt, be dynamic as we always had. So long-term, I'm optimistic. I do think, though, that we have some tough sledding ahead of us, and so we probably are not that far apart. It's just a matter of maybe having a little bit of a difference in degree of optimism over the next 3 or 4 or 5 months, perhaps. Because it seems to me, and one of the things I wanted to ask you about is that in certain areas we've created more demand, like with Clorox wipes as an example. But in other areas we've destroyed a lot of demand. Travel and tourism, restaurants, salons, a lot of Main Street American businesses, and bigger businesses too, we're seeing a tremendous amount of demand destruction. And it wasn't just a gradual decline that businesses could react to. It was a jarring, immediate change in the business climate. So I'm curious about how the demand destruction will get reconstituted. And a key question is how quickly does that demand reconstitute itself? People that are very super optimistic, more than even you, would say, once this is over, the government says that the shutdowns are over, all that demand destruction, that pent-up demand will come back. I think it might take a little longer because of that destruction and people feeling like they had their hands burnt on the stove and might be a little hesitant to get back to putting their hand on the stove is an analogy I'm using. So what do you think about the demand destruction and how quickly it comes back? Does it snap back right away, or might it take some time as Americans adjust to the new normal coming after the pandemic and the shutdown?
Well, over the past 30 to 40 years I've been watching it, I am simply amazed by the lack of patience with the U.S. consumer. They will spend money that they don't have. Remember when houses were appreciating like crazy? People were taking mortgages out and spending it as fast as they could, assuming that the growth in the real estate market was going to continue forever. People will have a pent-up demand, and a lot of people are going to spend money, and they're going to spend it quicker than you and I may even think. What you're saying, you're being rational. The problem is a lot of people are not rational, and when they are missing something, then they need hierarchy changes. And what was not a motivating factor before is now a motivating factor. And I want my ice cream or something. I want it now, and I'm going to buy the best ice cream I can buy because I haven't been able to get it, or I want the best cut of meat because I haven't been able to get it.
Sure.
So you could argue both ways. The only thing I'm saying is that that's one of the benefits of having you around. If some clients who have that attitude should be talking to you and encouraging you to speed up your dollar cost averaging. Those people who agree with that should not. But I don't want you to lose any clients because some people are more aggressive than you and I might, think. So I just think that your job is a tough job, is to just make sure that people understand that your job is to do whatever they think is correct. They can reflect on what I say and what you say and look at the time frame, whether it's 3 months, 6 months, 9 months, 12 months. But they should be giving you feedback to help you make a decision of how to help them.
Sure. It is difficult, as I believe I said in the webinar. I actually recorded 2 investor updates, and only one was actually published. But, this episode, this sell-off for me personally and professionally has been much more difficult for a whole host of reasons than previous bad episodes in the market. And like you, I'm a long-tenured guy in financial services, having been a financial advisor since 1992. Coming up on my 28-year anniversary, and I was working and at my desk on 9/11, literally that morning, and the aftermath of 9/11 was very difficult. Even though the country rallied in many ways around the flag, 2002 was a negative year for the markets. That was the 3rd year in a row. 2000, 2001, and 2002 were negative, so that was a difficult